Thirsty Thursday, and futures are higher. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, the old economy is hot again. Stocks in the Dow Transports are getting a new lease on life as a new wave of AI anxiety spreads across other sectors.
Nuveen is buying Schroders, creating one of the world's largest active managers with nearly $2.5 trillion in assets.
And President Trump's tariff agenda suffers its strongest political hit yet as the House passed a bill to scrap some of his levies on Canadian imports.
So we're still working our way through earnings, and one of the big ones that we got was Cisco, and that was a disappointment, Matt. I want to show you what it's doing pre-market. Down 6.5%. We're going to talk with Caroline about this in just a moment, but big picture story, weaker than expected forecast or profitability in the current quarter due to mounting memory chip prices, and that overshadowed an upbeat sales outlook, a problem the whole industry has been struggling with.
It's a $300 or $400 billion company, so it's big. On the flip side of that trade is the memory chip makers, which are surging as their price hikes boost margins. You can see SanDisk, Micron, and Western Digital, three of the biggest gainers of 2025 and of early 2026, putting up even more gains. So these memory chips continue to rally, Dani.
The trend is going nowhere. Let's bring in Bloomberg's Caroline Hyde to discuss it. Caroline, I'm almost surprised the reaction to Cisco is so big, because didn't we know this was a problem, that memory was really expensive?
And that it beat everywhere else. Revenue was looking healthy, up 10% for the quarter just gone. They beat on their bottom line as well. But what they're signaling is that this is expensive to get the right equipment in for the networking that they're building out, particularly when they're really leaning into the AI opportunity here. They say there's going to be $5 billion of orders for their AI more broadly for 2026. But if they're having to wheel and deal, having to do special negotiation with some of their suppliers, having to increase prices to those that are coming to them for the networking gear, it's just speaking to the difficulty that these companies find themselves in. Chuck Robbins was really quite bullish about the fact that they can deal with it probably better than anyone else because of the substantial place they have within the market. But this is wearing on everyone who's having to buy back. Just think how Dell has been implicated. Apple, we've also been worried about, even though it owns its own supply chain in many ways. The memory threat is eating into a margin that people wanted to see at 68%, and you're going somewhere 65 to 66% for Cisco.
SoftBank back to a quarterly profit on investment gains from OpenAI.
What a bet.
What's the story here?
4 straight quarterly profits, actually. We haven't seen that from SoftBank since 2021. They are all in on the AI build-out. Now, whether it's been committing to Stargate, $500 billion infrastructure spend here, alongside OpenAI, Oracle, and MGX as well, over from the Middle East. But this is Massa going back to his knitting. He has made his name by doing extraordinary bets on companies like Alibaba. We thought maybe he'd lost it during his way of the Vision Fund and the fact that we saw such a coming of reality to a lot of the tech stocks and indeed valuations at that time. But now OpenAI is just up and to the right. We're thinking it might be worth, $750 to $830 billion. Well, he's been building up his stake. He's got about 11% of the company. He's already spent $36 billion. He wants to spend potentially up to another whopping $30 billion on this company. But it pays off because the valuation keeps going higher. But look, this isn't like liquid money he's got sloshing around at the moment. And it's notable that he has been having to think creatively, get some more loan on margin, be able to sell off. Remember, he's been selling off T-Mobile shares to be able to buy more. He exited Nvidia entirely.
All right, really a lot to look forward to then, as usual, on Bloomberg Tech. Caroline Hyde co-anchors that program, kicks off at 11 a.m. Now, Nuveen is buying Schroders in a $13.5 billion deal. It creates one of the world's largest active asset managers, $2.5 trillion. Schroders CEO Richard Oldfield spoke on Bloomberg earlier.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at $2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
Bloomberg Deals executive editor Aaron Kirschfield joins us now. And Aaron, I mean, this is an active company, right? They just did a deal with Apollo. Now they're getting sold to Chicago-based Nuveen. Tell us about the behemoth being created here.
Yeah, I think this is all about scale because Schroders has been facing significant headwinds, as all active managers are. You need to have the scale, and it's also, people are putting their money into passive investments, ETFs, et cetera. So we have been chasing noise, rumors about Schroders getting taken out for over a year. And interestingly, the CEO himself said just this summer, no, the Schroders family is not putting us up for sale. There's no intention to sell. As we've all woken up to this morning, it was quite the opposite, and they are now doing a deal to get big and get big before they can't survive any further.
So what is it about this environment where you particularly need scale, Aaron? Is it rates coming down? Is it fee compression? Is it all the above? Is it something completely different?
It's a big mix of all of the above. The reality is the costs at Schroders were under pressure. They were being viewed as too expensive. Their stock was down 25% in the last 5 years, and people were just worried money investments were just not going through Schroders. So, they really felt the pressure, which is why even if they were publicly saying, no, we're not planning to sell, behind the scenes, people familiar with the matter have said they've been talking to various parties over the months, and they obviously found the partner they wanted, which has made commitments to staying, having a big presence in London, keeping employees here, keeping the Schroders name, which, is a very storied name in the UK. So it is a bit of a U-turn, came as a big surprise, even if there had been rumblings for days, if not weeks.
Aaron, thank you very much for that. Bloomberg Deals executive editor Aaron Kirschfield, who you and his team can catch on Bloomberg Deals, airs every Wednesday at 12 p.m. Eastern. In earnings news, McDonald's sales grew at the fastest pace in 2 years as its focus on value meals pays off. Bloomberg's Red Brown covered the earnings and joins us now. Red, is that what this is? The fact that you had McDonald's lower the price of its value meals, and that's why sales did so much better?
Yeah, I think that's a big element of it. And so the company is pointing to a lot, but there's also, they did really popular promotions as well. There's the Grinch meal that was like one of the best sales day in company history, they said. So that also really boosted the results, especially in the US. But I think overarching across all of their international markets as well, it is really this value push, being very conscientious of how they're raising prices, that is really getting foot traffic back into the stores, especially among lower income consumers.
It's interesting, as more people take GLP-1s, I would assume they avoid McDonald's, but it looks like they continue to go there, and they're driving comp sales higher at other fast food chains as well, right? I see QSR just came out with comp sales up 3.1%, higher than the estimate.
Yeah, I mean, the company was asked about GLP-1s, and they, again, this came up on Chipotle as well this quarter, and both companies seem like really not worried about this. They feel like they have a menu that's going to be able to appeal to these people. McDonald's talked about, they have protein options as well. They have the snack wraps, things like that are smaller and maybe just a little bit lighter for somebody who is trying to get the right macros and things like that, which I know you care about, Matt. In these meals.
I do feel like every ad I've seen, like I keep seeing this Chipotle ad that's like you can now get, or maybe it's Sweet Greens, you can now get like a cup of chicken, and isn't that the best protein you can get? And why would you have a protein shake if you can just eat a nice cup of chicken?
It is. Chicken is very high quality protein.
But I wonder also, Red, if some of the sales illuminate that they just raised prices too much in that post-COVID boom. That it's not necessarily that consumers are weak, but they just went too far with trying to hike up where their prices were, and they're correcting for that now. Yeah,
that's definitely, I think, the acknowledgement from the company. They really made a significant investment when they said that we're willing to go in, because you have to remember that McDonald's corporate doesn't necessarily set the prices. These are independent companies, these are owned by franchisees, they determine the prices. But McDonald's went to these people and said, look, we know you love the higher prices, but we need to bring them down. We need to reestablish McDonald's as the #1 value option for consumers. And to do that, they said, we're willing to invest with you. We're willing to make up losses from these price cuts that we're asking you to do. So they really do see that the problem was the prices, and they were willing to do what they needed to bring them back down.
All right, Red, thanks so much for joining us. Red Brown covers the restaurant business for us on the BN side. Quick check on what's going on in futures. You're seeing gains here, 1/3% on S&P futures. NASDAQ futures up a little bit more than that, and the small caps doing even better. In terms of our single stock stories, Crocs. Right up there.
Oh, yeah. Look at this move for Crocs. More than 13.5% of the pre-market blowing past estimates, seeing strong demand, identifying $100 million in cost savings. I gave my father-in-law a pair of Crocs for this past Christmas.
Who doesn't need plastic shoes?
You're welcome, Crocs.
Birkenstock revenue jumped 18%, speaking of footwear, in the fourth quarter as holiday sales of clogs and boots were strong.
Now, speaking of ugly footwear.
And yet.
That's the commonality, that just like big old bricks on your feet, plastic or leather.
But I guess Crocs are like the new Birkenstock, right? I mean,
sure.
for the new generation of
for the
like
kids.
lower IQ Gen Z.
That's horrible. But Birkenstock is popular among the kids, too. A very different industry. Brookfield profit rose in the fourth quarter. The company reported record earnings from its asset manager and strong growth in its wealth business. Those shares up nearly 2%.
Coming up, a rare rebuke for President Trump. The House gives part of Trump's tariff agenda a big hit. We're live in Washington next. This is Open Interest. It's getting out of high interest. Look at what's making headlines around the world. Clear Street Group is cutting its IPO size by nearly 2/3 after investor pushback. The broker now plans to sell 13 million shares at $26 to $28 apiece, down sharply from its earlier target. That trims the potential raise to about $364 million and lowers its valuation to $7.2 billion. The IPO still reportedly oversubscribed, though, and expected to price today. Citi says markets are too relaxed about U.S. inflation. The strategist argues that price pressures remain structurally higher and investors are underpricing risk. He recommends betting on five-year inflation forwards, now near 2.5%. Strong jobs data has already pushed Treasury yields higher. And in a major rebuke to President Trump, the Republican-led House passed a bill to end tariffs on Canadian imports, with 6 Republicans breaking ranks. The move highlights growing GOP anxiety over affordability ahead of the midterm elections.
Let's get more details on that now from Tyler Kendall, Bloomberg's Washington correspondent. Tyler, I'm guessing this is largely symbolic, right? Because Trump can just veto anything that comes to his desk. So what does this do in terms of actually pushing back on President Donald Trump's tariff policies?
Right, exactly, Dani. This is more of a message from lawmakers who say that they are feeling the pressure when it comes to the top issue for American voters, which is, of course, the economy. And you're right, this is going to be symbolic. President Trump can veto anything. The measure is probably going to go to the Senate next, where it actually likely will pass. But once it goes on to the president's desk, it would then take a 2/3 majority in both chambers in Congress to override his veto. So this isn't going to necessarily become law, but it does underscore how these lawmakers want to send a message to this White House. And it's interesting because if you look at the 6 lawmakers that went against President Trump, yes, some of them have long feuded with the president over other policies, but the other lawmakers really represent those critical battleground districts. And it was interesting to hear them talk about why they took this vote in the way that they did. Some of them are citing concerns specifically to their constituents, like one lawmaker in Washington state talking about how we've seen transport between Canada and the U.S. decline since these tariffs, whereas others spoke about some broader reaching impacts, talking about how the president took unilateral action and he didn't seek congressional approval when it came to his tariffs. With all of this said, we should probably still state that the vast majority of Republicans did vote in favor with the president. And part of that could have been a threat hanging over them that the president is going to put resources behind anyone who challenged him on this vote. He's going to back their primary challenger. And Matt and Dani, the numbers are pretty remarkable when you think about it. President Trump has amassed a $483 million war chest. People familiar with the matter tell us he is going to be directly involved in how that cash gets deployed as we head into November.
Tyler, I think it's safe to say that after the Trump-Biden debate, there was a bipartisan revelation that President Biden could no longer run for office again. And I wonder if there was a similar bipartisan reaction to Pam Bondi's testimony in D.C. yesterday. Listen to this clip.
Donald Trump signed that law to release all of those documents. He is the most transparent president in the nation's history. And none of them asked Merrick Garland over the last 4 years one word about Jeffrey Epstein. How ironic is that? You know why? Because Donald Trump, the Dow right now is over. The Dow is over $50,000. I don't know why you're laughing. You're a great stock trader, as I hear, Raskin.
So Pam Bondi, who is the United States Attorney General, had no answer to questions about why the Department of Justice unredacted the names of victims, why the Department of Justice has not released all of the Epstein files, why the Department of Justice kept the names of perpetrators redacted in a release to Congress, and why the Department of Justice has done nothing in terms of indictments or investigations into people accused of these heinous crimes. Is anything going to happen here?
Well, Matt, at this point, all we've seen really from congressional lawmakers is their ability to hold these oversight hearings. To your question on if there's going to be something tangible that comes from this in terms of perhaps Pam Bondi's job, President Trump has largely stood behind her. In fact, when asked last week about how she's doing, he defended the Department of Justice's handling of the investigation. He urged the country to move on, in his words, when it comes to the Epstein files. But as you're outlining, there are a lot of huge questions, and it is turning into an issue that has political potency. In fact, Thomas Massie, one of those lawmakers who voted against the president when it comes to the tariffs, has been leading the charge when it comes to getting out more information on these files. This week marked the first opportunity for lawmakers to view some of the unredacted files within the Department of Justice, though Thomas Massie raised concerns about those unredactions there, saying that there wasn't enough information that he was ultimately looking for. So it's going to be something to watch closely, since we know that the White House is really now playing defense on the issue. Again, President Trump throwing money behind Thomas Massie's challenger when it comes to the primary in May. This is going to be one of those bellwethers to watch on whether or not the party can get beyond this issue, or if there's going to be some other consequences for Republicans down the road.
The other issue that Trump risks the narrative, or maybe it already has, getting away from him, Tyler, is on immigration. If affordability, tariffs, and the Epstein files are two, this is perhaps the third. Chuck Schumer, the Senate Democrat leader, putting on X, we're 3 days away from a DHS shutdown, and Republicans have not gotten serious about negotiating a solution that reins in ICE. Tyler, where is this all heading?
So, Dani, today is actually a very critical day in the Senate, and it does look like it is highly likely that we could see the Department of Homeland Security shut down this weekend. What's going to happen today is that the Senate is going to put up essentially a test procedural vote on a DHS funding package that has already passed the House. That is likely to fail. That would have been for longer-term fiscal year funding. Next, what they will likely do is put on the floor a short-term stopgap measure that would perhaps fund DHS for another 2 weeks. But Democrats, as you just outlined there, as we heard from the Senate Minority Leader Chuck Schumer, are saying that they're not even going to get on board with a short-term patch until there are real negotiations for changes when it comes to immigration and customs enforcement. The issue is that the parties are just so far apart when it comes to this issue. Republicans have said some of those top demand from Democrats are essentially non-starters, such as new judicial warrant requirements or what's been called demasking of ICE agents while they're conducting immigration operations. What Republicans had wanted was for these concerns, these demands to be addressed through executive action. Let President Trump do them through some sorts of orders, such as body camera mandates, as one example. But Democrats are holding firm that they need to see these changes ultimately codified into law. The issue, Matt and Dani, is that if DHS shuts down, this is a massive department, 260,000 employees, and it's not just ICE that's encompassed in DHS. In fact, ICE is probably going to be shielded by any shutdown, considering that the agency was given funding to the tune of $75 million under the One Big Beautiful Bill. We're looking at the Coast Guard, FEMA, and TSA most likely to be impacted.
Tyler, thank you very much for those updates. That's Bloomberg's Tyler Kendall in Washington. Coming up, Kayla Cedar of State Street joins us to discuss AI disruption in markets and where this economy actually is. That's going to be coming up very shortly. This is Bloomberg Open Interest.
Year to date, value outperforming, which isn't necessarily a positive look on a go-forward basis for markets. Staples screaming higher, and I would characterize it as FOMO, but also financials underperforming at the same time. Extraordinary. That message tends to say recession ahead, but actually there's a much more nuanced story. It is really a manifestation of this AI disruption trade.
That's Julian Emanuel earlier today on surveillance. Let's bring in State Street macro multi-asset strategist Kayla Cedar. Kayla, wonderful to see you as always. I got to ask, because you obviously cover like the universe of investing. You have a very macro lens, but I'm wondering how many of your conversations with clients have been with AI disruption in recent days? Just how heavily is this weighing on everyone's minds?
Yeah, hi, Dani. Thanks so much for having me. AI is, for months has been the conversation. I think one thing that's standing out now when we talk to clients is, what does AI actually mean, and where do we get exposure? Where is it disruptive, or where should we avoid? And one thing I think that really stands out to us within the overall AI space is when we look at positioning across places like software, tech hardware, and semis, we still see lots of institutional investors looking for exposure to semis, looking for exposure to tech hardware, and they've decreased their exposure to software right around neutral. And so when you're thinking about these longer term investors, what are they worried about? It does look like they are worried about disruption in the software space. With that said, they're not willing to go underweight yet. I think they're just biding their time to get a sense of how disruptive this could actually be.
All right, Kayla, we're going to keep you with us through the opening bell. Kayla Cedar, on the AI disruption that we're watching and the rotation in this trade. In terms of futures, we are seeing gains today, 0.3% on S&P futures. At the small caps rising by 0.75%. When we come back, we'll give you the opening bell on the New York Stock Exchange and the NASDAQ market site. This is Bloomberg. Moments away from the start of cash trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are higher across the board. S&P futures up 0.3%. The small caps gaining almost 0.8% right now. At the New York Stock Exchange, FPS Forgent ringing the opening bell after a successful IPO. The shares have been trading for a couple of days and doing well. Everybody on the staff got the memo to wear a blue tie, except for that guy in the corner.
Call him out, Matt.
I mean,
no,
did he not check his email?
There's a guy in the back in gray. There's a guy in the back in gray.
Well, he
He's
made
hiding.
some really questionable decisions. APC, this is Arco Petroleum, also raising money in an IPO. They are, well, the parent company, Arco Corp, one of the largest independent convenience store operators and fuel vendors in the country. So like Easy Mart or Flash Mart or whatever. And then Petroleum, they do the wholesale vending to all these convenience stores around the country. So really interesting business.
I've never heard of them, but that makes sense. They're behind the scenes, I guess, for it. Here's a company that you probably have heard of. It's Cisco. Having a really tough session. Shares are down 6.6% at the open, a weaker than expected forecast for profitability. The reason for that, as you might expect, is mounting memory chip prices. And that is even though, Matt, that they had an upbeat sales outlook, but just their margins getting squeezed is the main issue for them.
Right. So Cisco's margins are getting squeezed by higher memory chip prices. Memory chip makers are doing very well today, and they have been doing well all year, and they did incredibly well last year as well. The biggest winners on the S&P 500 are the biggest winners today: SanDisk, Micron, and Western Digital. Let's bring back State Street macro multi-asset strategist Kayla Cedar. Kayla, I guess this is all going to somehow shake out in the wash, right? Because you want to buy the hardware, even if hardware makers are buying equipment from companies that are paying, are charging higher prices. What do you make of this trade? How do you sort it all out?
Yeah, I think the big picture is that the AI trade is continuing. I think the fact that we continue to see improvement in revenue growth, across the board within that AI trade is encouraging. But as you said, there is a cost to these chips. And so that's why we continue to see allocation towards some of these places like semis. But I think overall, the most important thing at this point is that we continue to see expansion and we continue to see revenue growth. And so I think that will bring back dip buyers within the overall AI trade if they've been a little nervous at the start of the year.
So far this year, though, there have been some more parts of the cyclical economy that have done well. Financials, yes, have underperformed, but things like industrials, again, things really tied to this economy. And we're all right now trying to figure out what things look like on the ground level. McDonald's was interesting, Kayla, because they came out with earnings yesterday saying that they cut prices and that allowed them to outperform. What is your sense for the more economically sensitive parts of this market? Where do we even stand?
Yeah, that's a great point, especially because there's a lot of uncertainty about the economy. And there's a lot of uncertainty for investors when it comes to how do I navigate a K-shaped economy? And so I think you have to think about, do these parts of the equity market service high-income consumers or lower-income consumers? And what does that mean for an overall portfolio? I think clearly we have seen some instances where if they are servicing a lower income consumer, typically, maybe focusing on how do we boost revenue is a really smart strategy these days. But I think the big picture overall is that we still see signs the overall economy is okay and is growing and is strong. We saw that in the labor data yesterday. We continue to see that in GDP growth expectations. And so I think moving forward, this should really also help places like industrials, places like some of these other cyclicals that have kind of missed out over the last 3 years.
Are we too sanguine on inflation, Kayla? Because, officials talk about we're coming back down closer to target. Yesterday we spoke with the Council of Economic Advisors head, Yared, and he also was saying we're getting back towards 2, but we want to average 2 over time, right? And we've been at 9. So, 2.5, 2 3/4 hurts a lot more when you put it on top of 9, the U.S. consumer. Do you think the Fed is going to have any chance to cut?
Inflation, I think, is the most important thing to watch in this economy. And the Fed knows this. That's why we have seen pushback on additional cuts. That's why we're in a period of pause, because the Fed needs to ensure that we can get back to 2% inflation. That's how Fed credibility, rather, is formed, is being able to support its dual mandate. And right now, we're further from that 2% target than weakness in the labor market. Unemployment at 4.3% does not signal a very weak labor market. Meanwhile, you look at inflation and we're still well above target. And I think that's what will keep the Fed on hold moving forward. When we look forward to the data tomorrow, really what we're looking for is at State Street, we do see the opportunity for a downside surprise on headline. But when we look at core, we're still expecting a print just above spot 3. And that isn't consistent with 2% inflation. And so I think that should push back on calls for additional cuts from the Fed because, as you said, Matt, we're just not back at target just yet.
Kayla, do you have an understanding of how markets would react in that scenario? Because equities have been an interesting one. Yesterday, for example, you got stronger jobs numbers. Yields push up. First, equities rally because I guess good news is good news, and then they fade. Different things affect the trading day. But is this a world where good news is good news for risk, or are higher bond yields at some point going to start eating into equity market returns?
Yeah, that's such a great point. And I think that has to do with allocation, is how I think about whether or not good news is good news or good news is bad news. I think more, where should we be allocated if we're seeing stronger data that might mean less cuts from the Fed? And I think, again, that supports this AI trade and supports sticking with high quality and pushes back on some of the arguments to rotate into small caps or rotate into riskier parts of equity markets, because we might be in an environment where interest rates are steady for a while, and we might actually continue to be in neutral. And so we want to be prudent and be pragmatic with where allocation sits into less interest rate sensitive parts of the market, I think would make sense.
Hey, Kayla, we're going to leave it there. Thank you so much for joining us.
Sorry, I just wanted to thank her too.
Yeah, go ahead. Thank her, Matt.
Kayla, thank you for joining us.
Thank you
seriously,
both.
Honestly, I hope we get you in the studio soon. I know Boston is a fantastic place to be, but come visit us in New York. Kayla Sater there from State Street.
Yeah, I also say thank you, just to be clear. We love having you on, Kayla. Okay, let's get a check on the stock market right now. About 8 minutes into your trading day. We are positive, up 1/3 of 1%. Yesterday, we ended, I think it was, I'm trying to remember. I know the move was 0.005%. I think it was 0.005% to the downside, which is flat. But it's just fun to go out 3 decimal points. Leading us this market higher, if NVIDIA is up, I guess we're up to Micron, Tesla, so some of the Mag 7, Broadcom. Equinix's home services company is up, which is why in a moment you'll see that real estate is one of the leading sectors. Apple, those shares are falling, but the big drop this morning is Cisco. Those shares down 7% after higher memory chip costs. AppLovin down 13%, and oil companies also dropping yesterday. Oil prices moved higher. Acid Energy maybe giving some of that back. So let's check out the sectors this morning. Again, I believe real estate will be at the top. Okay, I've gotten this one right. It is up 1.5%. Industrials, utilities, so some of the kind of bond proxy trades doing really well today. As I said, energy was up yesterday, so you give some of that back today. Energy falls, as does healthcare, communications, for a return so far of about 1/3 of 1%, Matt.
Yeah, the S&P yesterday closed down 0.00%, only 1/3 of a point off.
Yeah, 0.005, right? I think that was it.
0.005. Yeah, I only go out 3 significant digits, so I can't see that far. Coming up, it's not just AI that could disrupt Cisco's business. It's higher memory prices eating margins. In fact, that's the only problem. AI is, I think, very helpful to Cisco. We'll discuss with Bloomberg intelligence analyst Woo-Jin Ho. This is Open Interest.
Let's look at some of the top calls this morning. The upgrades and downgrades from the sell side. First up, JP Morgan. They're downgrading Kraft Heinz to a sell. They say that their plan to pause its split does not fix ongoing challenges. They also highlighted investor skepticism about the breakup. Those shares down 2.8%. Next up, Citi upgrades Ferrari, dropping the automaker's only sell rating. Citi says that bets against the stock have mostly played out and investors may come back after the recent sell-off. The analyst also says that Ferrari is showing it can manage its profits into 2026, which should calm worries in the near term. Shares are up 2%. And finally, RBC Capital downgrades Humana after the health insurance profit forecast missed Wall Street expectations. The company said that pressure from rising medical costs and flat Medicare Advantage payment rates drove the downbeat outlook. Humana was already beat up after its earnings, so shares are only off 0.5%, Matt.
Ferrari was up 1% on Monday, 8% on Tuesday, 6% yesterday, 2% today. So it looks like race is coming back. We're going to talk about Ferrari and collector car auctions later on in the program with Dave Majors, the CEO of Mecum. Cisco gave a weak forecast due to rising memory chip prices. By the way, I wonder how much these are affecting Ferrari as well, as they use so many microchips in their cars. Woo-Jin Ho of Bloomberg Intelligence says, quote, "We expect Cisco has plans to mitigate further margin erosion, but they may take a couple of quarters to fully implement." Woo-Jin joins us now, and you know, this is, I think, an interesting story, Woo-Jin, because we see the negative reaction in Cisco shares today. The memory chip makers obviously are doing well, but I think the story is AI is once again making Cisco like an incredibly relevant company. Not that it wasn't before, but more relevant, let's say. Is that the case?
Hey, Matt, that's exactly the point, and I think that's one thing that investors are missing out on. Cisco really wasn't in the hyperscale cloud customer base. They had high-end switches, and they were primarily an enterprise and corporate switching networking gear company. But they have chips, optical components that cater very, very well and to the hyperscale cloud customers, and they are very much into the conversation for AI and hyperscale deployments over the next couple of years.
Woo-Jin, what can Cisco and its peers do to mitigate some of the margin pressures they're facing?
Well, on the callbacks yesterday, they're changing some terms of the contracts to their end customers. I'll tell you an interesting tidbit. It seems as if since the memory cost is affecting everybody, it's a shared burden. So interestingly, the cloud guys are actually taking in some of the memory costs or absorbing some of those memory costs themselves. And that's probably some of the reasons why the cloud CapEx went up for this year.
I mean, CapEx is just the name of the game this year. $650 billion in hyperscaler CapEx. You got to think that a decent portion of that is going to go to Cisco. Who are the other hardware companies that are benefiting from that amazing spend? I mean, obviously we know NVIDIA, right, Woo Jin, but who are those that you may not be thinking about?
Yeah, so, I love talking about this topic because there's this whole layer and ecosystem of AI companies. Arista, which reports tonight, they sell networking gear to Meta, Celestica, Canadian-based company, and then Corning. That stock has risen primarily because they sell a lot of fiber optic cables to the hyperscale guys. So I call that the CC&A, so Cisco, Corning, Celestica, and Arista as some of the names that people should be aware of.
Is there anyone that gets left behind in this Woo Jin that's not keeping up?
Well, it's a very narrow race, right? When I think about networking companies for the hyperscalers, it's principally Arista, NVIDIA, and Celestica. Cisco has small share, but they have other layers of the network. The broader players, they'll probably won't have a foot in the door here.
You're looking at hardware specifically, Woo Jin, but what do you make of the SaaS apocalypse? What do you make of the devaluation in software stocks because of, expected AI disruption?
Yeah, look, there is a case to be made there, right? Because I think there's a lot of uncertainty out there, Matt, in terms of how SaaS models are built. You're going from a user-based model to an agent-based model, and it is going to disrupt how traditional software-based software models are built. And any time when you have this type of transition, I remember the perpetual to the cloud-based transition. It was 2 to 3 years of pain that the software companies had to endure before the revenue models worked out. We may see something similar to that with AI, with some of these SaaS-based names.
All right, Woo Jin, thank you so much for joining us this morning. That's Woo Jin Ho from Bloomberg Intelligence on some of the hardware pressures, or maybe where they are succeeding. Thanks to the demand from AI, and everything is AI coming up as the anxiety over it spreads. Investors turn back to the old economy stocks in the Dow Transports, but aren't they AI too?
Everything. Yes, totally agree. Yeah.
We're going to talk about that coming up next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on a changing stock market. We have still gains on the S&P 500, 69.53, the level here. So getting ever closer to Pam Bondi's celebrated 7,000 level. The NASDAQ 100, though, turning lower, down just 0.1%. Still, as the Attorney General said, we're breaking record highs here in these indexes. If you look at what's going on in the individual stocks, NVIDIA right now up 1%. That's helpful to the S&P, should be helpful to the NASDAQ as well, but you've got some drag. Cisco being one of them. Of course, it's only worth a tenth what NVIDIA is, but Cisco is down 9%. I don't remember it being down 9%. Birkenstock also falling after earnings that looked at first blush good, but investors are selling those shares as Crocs comes up. Crocs gaining a fifth, or adding a fifth to its market cap today, up 20% on earnings. You've got Boeing gaining 2 1/3% right now, one of the major components of the Dow Jones Transportation Index, which today is up, but also more importantly, is up year to date almost 15%. In fact, you can see the Dow Transports here in yellow, or in orange. Amber, I guess, is the color on the Bloomberg terminal, beating the returns of the Russell, the small caps in blue, beating returns of the Dow Jones Industrial here in pink, or magenta, as you may want to call it, beating returns of the S&P in white, and the NASDAQ here in purple. Or is it lilac? In any case, the transports are doing well. And that may, for some, confirm Dow theory. Listen to what Ann Milletti had to say about what's driving this resurgence.
I think what we're seeing now is a little bit more of a shift toward, okay, we're getting engaged. We may not know where tariffs really fall out longer term, but we're getting more comfortable that we know where the average will be. And that's I'm kind of speaking for the general sentiment we're hearing from companies. And so they're going out and spending. And so that corporate activity overall is driving both the manufacturing data, but also the transportation data as well.
Joining us now is Brooke Sutherland. She's Bloomberg's Boston bureau chief and writes the Industrial Strength newsletter. And strength there has been, Brooke. What's been behind it?
You know, I think if you look back at 2025, it was really a tale of two economies in the industrial space. And so, you know, there are manufacturers that play to this AI theme, electrical equipment companies, cooling companies that, you know, whose equipment is really essential for the data center build out. That was booming. Aerospace was as well. But the rest of the industrial economy has been mired in, you know, what's really been sort of like a 3-year slump. You had that inventory hangover coming out of the pandemic that turned into something more persistent as it sort of collided with tariff concerns, inflation, higher interest rates, what have you. And so, you know, analysts and investors have been looking for these companies to start to see a recovery for a while now. And I think you are starting to see that, partly because there's just easier comparisons to years past, but we are starting to see that demand perk up. And I think this idea of getting, you know, some sort of comfort with tariffs is really key to this, because we saw a lot of capital spending plans put on hold or delayed or dialed back or what have you. And you're really starting to see that perk up. I think one of the things that was interesting this earnings season is the capital spending increases that we saw from a bunch of companies, not just those supplying the AI data center theme, but those who are looking to sort of, you know, refurbish their factories or make investments in the US or what have you. That really did start to pick up. And one of the things in industrials is one company's CapEx is another's revenue. So it really does become, you know, circular and build on itself.
You know, I look at the winners on the Dow Transportation Index so far this year, Brooke, and there are those that you would expect. I guess FedEx and UPS, Hunt, you know, JB Hunt Transport Services. They have to move stuff around as the economy grows. They're moving more stuff. The airlines are interesting to me because Southwest is one of the biggest winners, is up 27% this year to date. Alaska Air up 17% this year to date. Are those idiosyncratic stories or are they industry stories?
I think, you know, Southwest is more of an idiosyncratic story. You did have that activist get involved there. They're making a number of changes to their business model in terms of, you know, shifting their boarding practices and their willingness to lean into those premium seats. In terms of United and Delta, I mean, they've really been the standout performers in the airline industry. But I will say, you know, what's interesting is a lot of that growth has been driven by the premium cabin. They are not seeing that main cabin recovery yet. And, you know, it was really striking on Delta's earnings call to hear them talking about this, that recovery for the main cabin is just really not materializing, and that gap between the premium flyers and the main cabin is the starkest it's ever been. And so I do think that's something interesting to keep in mind here as we talk about an industrial recovery. It is really hard to have a very meaningful industrial recovery without a consumer recovery. And the consumer has consistently been the weak point in these industrial earnings that we've gotten so far. If you look at companies like Stanley Black & Decker, you know, talking about increased promotional activity and consumers trading down in terms of vacuums and power tools. Pentair is not forecasting any kind of recovery in the residential pool market in 2026 to sort of help out its guidance. You know, Carrier, a lot of the HVAC companies have been similarly very conservative about the prospect of increased consumer spending on heating and cooling systems. And so I think as we think about, you know, what this industrial recovery ultimately looks like without the consumer, it might end up being pretty shallow.
All right, Brooke, thanks so much for joining us. Brooke Sutherland there runs our industrials coverage. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. After a flat day yesterday, like almost literally flat, 0.005 was the decline. We're flat again today. So Nothing happening. We'll see if that changes over the next
Flat,
several hours.
but near record highs,
True.
as the Attorney General pointed out yesterday. Wall Street bracing for key inflation data set to publish tomorrow.
President Trump's tariff agenda suffers its strongest political hit yet. The House passes a bill to scrap some of his levies on Canadian imports.
Plus, Ferrari Fever, a white 1962 250 GTO, helps drive record-breaking sales at Mecum auctions. Somebody paid $18 million for an Enzo. We're going to be all over these results for you with Hannah Elliott and Dave Majors later this hour. There's the yellow Enzo, by the way. 694 miles on that car.
Wow.
That orange Porsche 918 went for $6.5 million. That's another Ferrari Enzo that went for almost 10.
Do you think Nancy Tengler has opinions on this?
I've never talked to Nancy about cars, but she seems to know a lot about everything, so I would not be surprised if she knows.
Let's bring in Nancy Tengler with stocks hovering around new highs. Laffer Tengler, CEO and CIO. Nancy, I won't ask you about the Ferrari unless you have strong opinions. I don't know. You tell us. Are you a car person?
Kind of.
Okay.
Well, I did go to the Bob Bondurant School of High Performance Driving. So
wow. Very cool. Very cool. Nancy, we learn something new about you every day. Okay, let's put that to the side for just a moment. This environment we're living in, AI anxiety, is there too much spending happening? Who's getting hit? I know you've been writing about how these couple of weeks, or at least the start of the year, has had a deep-seek kind of flavor to it. What do you mean by that?
Yeah, well, so thanks, Dani, for having me and Matt. The DeepSeek moment, I was actually on air when the news came out, and what we counseled was, due to the implications and the results of Jevons paradox, that you wanted to be a buyer as the technology became ever more popular and used. Then prices were going to come down, and there was going to be a broad-based result, and that is what happened. We looked at a number of the names that we owned from DeepSeek to Liberation Day, and then Liberation Day till the end of the year. And I can only remember one off the top of my head, but it was Teradyne, which was down over 20%, and then ended from DeepSeek to the end of the year up over 100%. So these periods of volatility, if you believe in the long-term story, which we do, they become opportunities. And so we were buying last week on Thursday. Didn't know the market was going to rally on Friday so hard, but we felt like some of the names had become washed out. And so we added to some software names, we added to Apple, and we added to some of the infrastructure names. That's the only way I've figured out how to make money in the stock market, is buy when stocks are down and then trim them back or sell them when they're up.
That makes sense. Buy low, sell high.
Thank you.
Do you not worry, Nancy, about AI eating the lunch of these software providers? And that's the narrative, right? The idea is, if I have a super smart and capable AI, I can tell it to look at my CRM software that I pay high monthly bills for and just replicate it, maybe even make it better, and I own it. Is that not a concern? What are the moats? Is the question I've been asking.
It is a concern, Matt. And I think that drove us to exit quite a while ago, by the way, Adobe and Salesforce. The seat business, which is Salesforce, I think there's better places to be. And I think Adobe totally fumbled the pivot and didn't pivot. And so you've got a stock that we exited because of that. That said, I don't think Microsoft is going to be even marginalized. And they've now announced that they're going to expand and really double down their efforts on the agentic side of AI, and also just on their offering. It's not very good. And so I think they've got it, and they're going to pivot just like Google did. Remember Google not too long ago, like a year and a half ago, was in the Russell 1000 Value Index. Nobody's talking about the disastrous introduction of Bard, so they rebranded to Gemini, doubled down on their efforts, and now they're considered the leader, or at least one of the leaders in the race. We owned it in growth, but we added it to our value portfolios, and it's done quite well, but it was left for dead just a year and a half ago. So you need smart management teams that are going to make the pivots. I think Satya Nadella is interested in winning, and so they are sort of distancing themselves from OpenAI, which I think is a good thing, and really focusing on building their own models, which is also a good thing.
It is quite incredible to see how Alphabet just seemingly zoomed ahead with their Gemini offering. Nancy, you mentioned that you were buying some of the dip in the software stocks. I know you said you had dumped Adobe. That's less attractive to you. What are some of the stocks that you said, okay, these are the babies thrown out with the bathwater. They have that moat that I'm looking for and I'm going to add?
So we added to Palantir, and I think, the earnings were incredible. The backlog's incredible. The valuation is also incredible. But in these narrative transformative stocks, sometimes valuation doesn't matter. And I just, I've pointed your attention to this before, but Amazon since IPO is up 250,000%. I mean, when was it too late to get in? When was it overvalued? Pretty much the whole time. And so I think you want to own Palantir as one of the disruptors and winners in this game. And then we added to Microsoft. We also added to Apple, which is kind of like the treasury bill of technology. And we added to Eaton and GE Vernova on the infrastructure side of things. But Microsoft has the ultimate moat. I think Palantir has a moat, and particularly with government contracts. And Apple is just a good plotter. So we put it, we added to it in our portfolios.
How do you think about, Nancy, the midterm elections coming up? Because as the administration gets hurt on the immigration narrative with ICE killing Americans in Minnesota, and as Pam Bondi gives disastrous testimony in front of Congress yesterday, I start to think about Palantir maybe too deep in bed with this kind of police state. Does that not worry you?
Oh, yeah. I mean, everything worries me, Matt. It's a risk to the stock, and it's a risk to future revenue and earnings growth. I think, I've been watching you all morning, and I've been laughing at your Pam Bondi references, because I do love when when cabinet members cite the Dow, like they had something to do with it. Anyway, I do think that, it's not our largest holding by far, but we want to participate with it. And if the revenue growth begins to slow, then we'll exit. But we look at a lot of these companies on a price earnings to growth basis. If you look at a company like ServiceNow, that's one that the debate is still out there, but it's trading at a peg of 1. And historically, it's traded 4 to 5. So I think you just want to we have to pivot as quickly as managements do, and that is what we've done in our portfolios, which is why we've been able to generate excess return above the S&P for a number of years.
Nancy, how are you feeling about financials? There's a weird thing going on where financials, the overall index, is underperforming so far this year. It's down on the year. It's the worst sector. But then the regional bank index keeps hitting new highs. So the smaller banks are doing really well, but the rest of the financials, especially, there's new drama this morning. Peter Navarro on Bloomberg Radio telling Jamie Dimon something like, friggin', lower your credit card rates or something along those lines.
Yes, using the term friggin'.
Truly, that wasn't me bleeping myself. He said friggin'. How are you thinking about the sector and the subcomponents within it?
Well, so our overweights are in the two names that have less interest expense dependence or income dependence. So think Goldman and JP Morgan. And then we own our largest holding in financials is American Express. But we do own some of the regionals. And I think the trade is about deregulation. And that's important. And those are the things that you can't quantify. Like we know for a fact that Amazon, for example, spent 50% less on taxes last year, thanks to the One Big Beautiful Bill Act. That we can quantify. But the impact of deregulation is very difficult to quantify. And I think the regional banks stand in the strongest position to benefit from deregulation. And so I think you want to continue to own those names. PNC, US Bank Corp, those are names that we like, Huntington Bank shares. So those are in some of our large cap portfolios.
I'm looking at your notes and talking with other guests about this today. I just keep thinking about the massive CapEx and how it's like a stock picker's paradise, right? Because you can look at where this money is going, follow the trail, and just buy these companies. You mentioned Palantir that are just getting a huge boost in revenue from it. Where do you see that broken down in terms of software versus hardware? Because that's been the market tug of war, right, over the past couple of weeks. Are you firmly entrenched on the hardware side with the few software plays we've talked about as exceptions?
Yes, we are, and have been, and we've talked about it on your show. One man's CapEx spending to the tune of $700 billion this year is another man's revenue. So in my 5 for 25, I had Broadcom, and that's in our 12 best ideas portfolio. 6 for 26, we added AMD, which is a name that we like. We own NVIDIA, of course. We also own Cisco. I thought that was an excellent earnings report. I'm sorry that margins shrunk by 1% to 67.5%, but I do think that that's a name you want to own for the long term. We added IBM not so very long ago and haven't owned it for decades. So I think those are names, Teradyne, all names that we own and like, and we have in multiple strategies. And we have been active trimmers. I mean, Broadcom would be 15% of our portfolio if I didn't trim it back. So we run concentrated portfolios, but not that concentrated.
I have a viewer writing in, says, ask her if CapEx may damage market returns. No one is asking that. And it's a fair point. And it's something I think that some of these leaders, Mark Zuckerberg, have talked about a little bit. What's your view on that, Nancy?
Well, so I think CapEx has actually driven economic growth, and we're seeing it not just in the spending, but in the productivity. But I will say that when I grew up in the business, Matt, a little bit before you, CapEx was good. If companies were spending on CapEx, R&D, that's because they anticipated growth and monetization of whatever they were investing in. I believe that is true now, but what you're hearing, like we've had one of the best earnings seasons in recent memory. Triple plays have not been rewarded, beat, raise, because everyone is laser focused on CapEx. And so, yeah, it's going to lower free cash flow in some of these companies. But for example, Google has $126 billion on their balance sheet, more than almost every country around the globe. Microsoft has $89 billion. This is very different from the 90s when they were fueling CapEx spending with debt. So I do think investors need to step back, and I think they will. And we'll see a more sanguine view about CapEx. It's now, I think tech CapEx is now almost 50% or just above 50% of total CapEx spending. We're in a transformative economy. That is what's going to happen as we transform to these new technologies, not just AI, but space, robotics, quantum, and even nuclear power. We run a thematic portfolio with those sectors in focus. So I think the CapEx spend is in line. It's not very high above trend. And in the 90s, it peaked way above trend, and it was all decade long. We're just getting started. So I'm pretty sanguine about the CapEx numbers.
I think we grew up at the same time, Nancy. I remember seeing you out there at Point Loma smoking Marlboro Reds in your white knit jean jacket. Nancy Tengler of Laffer. Tengler, thanks so much for joining us. Quick look at what's going on in these markets as we saw a little bit of a gyration here, and the NASDAQ now down 0.3%. We were looking at gains at the open. The S&P 500 still just holding its head above water there, 0.07% the gain.
Some of the single stocks that we're looking at this hour, Nancy mentioned that she likes Cisco with strong earnings, but their margins were under pressure, and that's enough to send shares down 9.5%. It's the mounting memory chip prices that have hurt them.
McDonald's sales grew at the fastest pace in more than 2 years, thanks to the company's focus on super cheap value meals. I also did want to point out that trucking stocks are getting slammed today. C.H. Robinson, that's down 10.8%. Expeditors International, that's also down sharply. I've had quite a few people writing in, pointing this out, saying, is it something to do with AI that's hitting these trucking stocks? But I don't know. I'm multiple people pointing this out and freaking out about how poorly they're getting hit right now. Well, we were looking at the Dow Jones Transportation Index earlier, and it was up. Yeah. And it is now down 1%. So there's definitely a swing that we're watching in these markets. Coming up, Bloomberg Intelligence says the tech debt binge is just starting as companies ramp up AI spending plans. But is the buyer confirmation or just desperate to get rid of his cash? We'll talk about that on Open Interest. Let's get to high interest. Look what's making headlines around the world. President Trump is ending sweeping federal immigration operations in Minnesota after weeks of protests and congressional backlash. The border czar Tom Homan addressed the retreat in a press conference.
in the success that has been made addressing public safety threats and other priorities since this surge operation began, as well as the unprecedented levels of coordination we have obtained from state officials and local law enforcement. I have proposed, and President Trump has concurred, that this surge operation conclude. A significant drawdown has already been underway this week and will continue through the next week.
Russia is floating a return to the U.S. dollar system in a proposed economic reset with the Trump administration. The high-level memo details several points where, in the Kremlin's view, Russian and U.S. economic interests could converge, including joint oil and gas ventures, critical minerals deals, and nuclear cooperation. The shift would reverse Moscow's de-dollarization drive and could test its deepening ties with China. And big tech is borrowing at record levels to fund its AI spend. The passive bond funds are snapping it up. Some investors warn the flood of new debt could rattle markets, especially with risk premiums already low, as more highly rated tech bonds enter indexes. Corporate bond funds may start acting more like government bond funds, leaving everyday investors more exposed to interest rate swings.
And joining us to do that is Robert Schiffman, Bloomberg Intelligence Senior Credit Analyst. Robert, thanks so much for joining. Thanks. And I know that you've analyzed this debt coming from the tech power players and saying this is healthy, it's a healthy market, there's clearly demand. But what's the dichotomy between being people wanting to specifically buy this debt versus money that just needs to be put to work, really tight spreads, and limited supply at this moment?
Well, first off, bad news sells. So I think what we see is a tremendous amount of conversation about how the sky is falling. So I'm here to tell people that I don't see the sky falling. I'm looking up and it's clear blue, sunny skies. And for those bondholders out there that are worried, there are a lot of people like myself that got your back. And there's a lot of good reasons. And I think it's primarily all the data points that I've seen so far year to date that have worried some have made me feel better. I think an increase in capital spending highlights how much some of these companies see in future demand. Second, I see the amount that they're borrowing. Yes, leverage is going up a little bit, but I also see bondholder demand, record order books that we're seeing. Even for the problem childs, like the Oracle's $130 billion order book. We saw Alphabet earlier this week do a bond deal, $100 billion US book, and do a 100-year bond. What are we going to see next? Somebody issue a 500-year bond, a 1,000-year bond to prove that there's demand out there? So the last thing maybe is just fundamentals.
No one needs to prove there's demand, dude. I mean, of course, just look at spreads. They're tight across the curve, right? I mean, you can sell bonds if you have no credit rating or a great credit rating and not pay much more than treasuries.
Maybe so, but the reality is when we're talking about this debt deluge, we're talking about AA and AAA credits primarily. And that's where there's a tremendous amount of room. Why have such good balance sheets if you're not going to use them? You know, in the past, what did these companies do with all their excess cash? They gave it back to shareholders. What's the return of capital on that? It's absolutely zero. And if you think about buying back $100 billion worth of stock, if you're a $3 or $4 trillion company, does it really matter? I would much rather have them spend money on CapEx to drive future revenues and cash flows. If you look back, what was last year for all these hyperscalers and the Mag 7s? Record revenues, record EBITDA. What are we looking at consensus for this year? Record revenue, record EBITDA. And next year, and the year after. It makes a ton of sense to pour good money after opportunity.
What about this concern about just changing the dynamic of this bond market? That one of the pillars of keeping spreads tight has been limited supply. And all of a sudden, you're going to be rushed with a lot of supply, good or bad. It just creates more out there, and that in itself leaves us more vulnerable to a blowout in credit spreads.
Yeah, listen, that is a fantastic question. And I think there is a difference in fundamentals versus valuation. So fundamentals, obviously, I couldn't be more bullish. From a valuation perspective, you know, when we came into last year, we knew how big CapEx was going to be, at least in terms of a couple $1 trillion. We didn't know it was going to grow as fast as it did. And we had been suggesting that spreads, at least in high-grade tech, was going to widen out and underperform because of issuance. We saw that, but it was mild. And now high-grade tech bonds trade basically on top of the high-grade index, which is near its all-time tights. So could we see a little bit of weakness going forward if we see another record year of issuance? The answer is yes, but it's such mild issuance, and it is nothing in comparison to these massive type of equity vol moves that we're seeing. So I think if you start thinking about excess returns versus just mild spread widening, you can still see positive excess returns for these tech names, particularly as they're coming at concessions. And the one thing that I don't really worry about when it comes to big technicals and how big part of an index they're going to be, or are people going to be full? No one is ever full on anything if the price is right. So if you can offer bonds at a cheap enough concession, people are going to buy them. Maybe that causes a little bit of underperformance. But when thinking about the size of this market, the Bloomberg High Grade Index is $7 trillion. Technology is about 10% of that. Net new issuance last year, it was a record of issuance, but net new issuance was only 60 billion. Let's say we break the record this year and there's 300 plus billion of high-grade tech bonds that are issued, and there's net new issuance of 150. Okay, so tech goes from 10% to 12%. That's not overloaded for anybody, particularly for the highest quality, and I keep saying it, Mount Rushmore credits of this market.
All right, great to get your take, Robert. Robert Schiffman from Bloomberg Intelligence watches tech credit for us. Still ahead, Ferrari Fever hits Florida. We'll speak with Mecum Auction CEO Dave Majors about this massive auction result. Dude. Let's get a check on what's going on in these markets as they swing lower. The S&P 500 still holding on to gains 0.1%, but the Nasdaq down 0.25% as the 10-year yield comes off at 414. Coming up, the Ferrari 5 shatter records at the Mecum auction in Florida, and that is reverberating across the industry. We'll speak with the CEO, Dave Majors, next. The Mecum auction in Florida set a blistering pace for the collectible car market, with the Ferrari 5 smashing sales records in the span of 2 hours and the auction reaching $445 million in sales. The top seller was the Bianco Speciale 1962 Ferrari 250 GTO, which sold for more than $38 million. The former racer is considered a crown jewel for elite collectors, one of just 36 built and the only white one to leave the factory. Here you can see David Lee, the buyer and prominent Ferrari collector, standing with his prize there. He is the CEO of Hinghwa Lee Jewelers in Los Angeles. I think they have a store in Larchmont as well. Joining us to discuss is my Hot Pursuit co-host, Hannah Elliott. And Hannah, we've been talking about this for really a couple of weeks now, but it is spreading like wildfire across, industries. People that don't even know cars are talking about the sales that were made, including, I think, $18 million for an Enzo. What do you make of it?
Well, it's really interesting. And of course, we know that Ferraris are blue chip collectibles. We've seen this for a long time. What's unusual is the amount at which they're selling, which is like double normal, which is already high. So yeah, it is catching on like wildfire. And everybody I'm talking to is saying it all started at this Mecum auction in Florida, where David Lee did buy that 250 GTO. It's just a convergence of a lot of things, also driven by a lot of new buyers into the collecting world, and also younger buyers who are really into these sort of classic supercars, for lack of a better word.
What's bringing this like new type of buyer and younger buyers into this market, Hannah?
2 words for you: social media. And that might be a bit reductive, but I don't actually think really. Social media has just meant that everybody can see these cars. There's so much content around collectibles, vintage, classic cars. People are really starting to understand how cool they are, and it's very easy to network and show your cool car. David Lee is a great example. He's very open with his massive car collection. So social media is huge, and this is driving the sales of online auctions, which makes it very easy to bid on and buy cars. Bring a Trailer, which is an online platform, did $1.7 billion in sales last year. Matt and I often exchange Bring a Trailer links. So it's just this whole proliferation of easier looking at cars, easier bidding on cars, easier buying cars. Everything is just lifting up. And as we have more and more people who are in their like 40s. 40s is considered young in the car world. 40s and 50s
I consider
is
it
pretty
young too.
Yeah. More and more of these types of people can now afford to buy the cars we had on the posters on our wall or loved in the music videos. So it's just like a perfect storm of a bunch of factors.
There's even AI. I saw Johnny Lieberman now has created an AI tool that helps you bid on Bring a Trailer and what's Doug DeMuro's
dangerous.
and Cars and Bids.
Cars and Bids, yes.
It's interesting. By the way, did you book David Lee for our podcast? Is he coming on Hot Pursuit next week?
David Lee is coming to us next week to tell us all about this car, why he was chasing it, he actually got a great deal. $38 million sounds like a lot of money, but that car for 2 years was being offered at about twice that, especially in Europe, and he can tell the story behind that. So he actually got what is considered a great deal on that car. So yeah, he's going to come talk to us next week.
Well, and I've heard a theory, Spike Feresten of Simpsons and Seinfeld fame has a podcast where he was saying, like, the kids, and this is to your story's point as well, the kids are making these 80s and 90s and early 2000s cars like the Enzo Ferrari, the ones that you want, like the crown jewels at these auctions. And maybe the 60s cars like the GTO, which has been the crown jewel for our entire lives, maybe less valuable. I mean, back in the day, everybody wanted the Bugattis, right? The old pre-war Bugattis, and now no one ever even talks about them. So maybe we're just moving into a completely different era, and that devalues the cars of old.
There's definitely a vibe shift, and of course, a vibe shift toward exactly what you're describing, these young timer, modern classic cars. A big part of that too is they're just easier to drive. They're easier to maintain. Yes, they're 20-year-old cars, but they're a lot easier to drive than something from the 60s. But yeah, we saw that with pre-war cars too. They've fallen off a little bit. And I asked, back to Bring a Trailer, I talked to Randy Nonnenberg from Bring a Trailer, and I asked him that same question. And he said, yes, it's true, but you know what? Things are still selling if they're really good. It's almost a K-shaped curve. We hear talk about that a lot, where he mentioned a pre-war Cadillac that had sold on Bring a Trailer for over $400,000 recently. So there is interest in the best of the best, no matter the era. And on the flip side, the good news is the falling off of interest in some of these older cars means there's an opportunity. If you actually do want one, maybe you can get a nice little deal.
I was actually following that Cadillac. 16 cylinders. That Cadillac.
Wow. I didn't expect that for you, Matt.
Yeah,
That's
well,
cool.
I mean, it was like a 9-seater. I need that for my growing family. Hannah Elliott, thank you so much for joining us, my Hot Pursuit co-host. And obviously, you can check out our podcast every week, me and Hannah, and we usually have great guests as well, talking everything cars. Joining us now is the man behind that auction. Dave Majors is the CEO of Mecum, and Dave, to Hannah's point, Kiss Me really kicked off this massive month. I think over $1 billion in collector cars traded hands in the month of January alone. What do you make of the vibe shift with the Enzo going for $18 million and the GTO going for only $38?
Well, good to see you again, Matt. Thanks for having me on this morning. Certainly, Kissimmee was quite a spectacle. I wouldn't say that we expected what we saw. We did expect that Kissimmee was going to be a monumental event for us, but maybe not at the levels that it actually turned out to be. And I think there are really two stories in Kissimmee. Of course, everyone wants to talk about the 1962 250 GTO that sold for $38.5 million, and the other huge spectacle, the Bachmann collection of 46 Ferraris and a couple of other cars and a motorcycle that brought a little over $120 million. But if you look at Kissimmee in total, and with some post-auction sales, we're close to the $460 million range, which broke our old record for the most sales at a collector car auction of $260 million. So a considerable achievement. But what I think is more important is if you take the 250 GTO out of the mix, out of the sales totals, and if you take the Bachmann cars out of the sales totals, Kissimmee auction was still $300 million, still another record setter, surpassing our $260 million record that we had set before. So I think, yes, we had the one-offs. We had the great collection that, probably most collectors aren't going to see in a lifetime in the Bachmann collection. You don't take a 250 GTO to auction every day. But I think the more telling story is what the rest of Kissimmee meant to where we think the collector car hobby is going.
Well, Dave, just kind of on that point, I'm told, as by Hannah Elliott, as it just so happens, that Mecum had been known for selling volume of maybe more low-end Mustangs and that sort of thing. Your ability...
Kudos.
Okay, thank you, Matt, for that. I did not know that. But your ability to get these sales, these auctions, where we're talking about multiple millions, tens of $millions, does it represent a shift for Mecum as a whole?
It may look like that from the outside, but we've always been in that business. We've sold cars for $7, $8, $9, $10 million previously, but we are also in the volume business. We're also in the American, muscle car business. Typically, like everyone else, we have loaded up our Monterey docket in August with some of the higher-end cars. And as you know, pretty much all the auction companies are doing the same thing in Monterey. So we're competing with events. We're competing with other auction companies. We're competing for a limited number of high-net-worth buyers when we go to Monterey. But we made a decision several years ago. I don't know if you are familiar with the book from the 90s called Blue Ocean Strategy. The context of the book is you can compete in a bloody red ocean or you can create your own pristine blue ocean. And we made a conscious decision that we were going to create our own blue ocean, our own high-end auction in Kissimmee, rather than loading up the Monterey auction with all the high-end cars. And you've seen the culmination of that strategy now with what took place at Kissimmee this last January. That doesn't mean we're abandoning Monterey. We're still going to do what we do and what everybody else does in Monterey. But we are building Kissimmee not only to be a high-volume auction, not only to be American muscle cars, but now very high price tag cars, and a lot of the exotics, as you saw with the Bachmann collection, as you saw with the 250 GTO. But again, aside from those, there were a lot of other very high value cars that went to Kissimmee. We sold 54 cars over $1 million in Kissimmee this year.
Dave, I mean, you in your CEO role and Dana Mecum have certainly hit it out of the park with this auction. So I got to get this Blue Ocean Strategy book. But I wanted to ask specifically about the Enzo. I never knew I wanted an Enzo so bad until one sold for $18 million. And what do you tell people about the buyer? Like, who bought this car? I've heard so many theories about what drove the price up. Maybe a guy who already owned 6 was adding a 7th. Maybe it was a couple billionaires sitting next to each other that wanted to have the lowest mile yellow Enzo out there. How transparent can you be in this business?
Well, we don't name names. We let buyers tell people that they bought certain cars if they in fact choose to do that. We're not in the business of exposing who the buyers are. Particularly, we don't know if they want to be anonymous or not. But I think we had 3 very spirited buyers that were bidding on that car, and obviously they all had the capacity to be able to buy the car for what it would take. But it starts with the car. I mean, again, we had a lot of unicorns in that Bachmann collection that brought exorbitant prices. And when you look at the yellow Enzo, the Giallo Modena, 649 miles, one of 11 cars, same owner since new. I mean, it had everything that you're looking for as an investment type collector. And I heard, as you were talking earlier with Hannah, that the market for high value cars, for cars with great provenance, with great histories, with low miles, cars that have been very well taken care of, cars that maybe have one owner, there's a very strong market for those cars. The buyers in the market today are not only collectors, but they're investors. And they're looking for quality investments, quality vehicles that they can invest in. And I think this, when you think about collector cars, that Enzo is pretty much top of the list.
Dave, just kind of quickly, like, what sort of KYC do you do? Because I know the auction world for art, for example, had been rife with people who had gotten money through unsavory ways, looking at ways to store, to hide, to save that money. Considering there is some anonymity in car auctions too, what sort of things do you do to prevent those sorts of actions from taking place?
Well, as you might imagine, when we have people that are bidding on cars like the Enzo, bidding on cars like the 250 GTO, and a whole host of others that were sold at Kissimmee, we pretty much know those buyers. We know who they are. Sometimes we don't. We do have a vetting process that we go through as part of the bidder registration process. That, I would say it's not foolproof, but we have very little instance of shenanigans, if you will, going on in the purchase market of collector cars.
Does everybody pony up, Dave? I mean, are you at liberty to say whether the buyer of the yellow Enzo actually paid for it already?
Yes, the cars have been paid for. That is correct. We have, coming out of Kissimmee, if you would imagine, we offered 4,300 cars. We sold 80% of them, and I have less than one hand of vehicles that haven't been paid for, and most of those are $50,000 cars and $25,000 cars. So there's, for the most part, everything that was monumentally significant was paid for pretty much immediately after the auction.
Dave, thanks so much for joining us. We really appreciate your time. Dave Majors, Mecum Auctions CEO. Coming up on the show, Anthropic edging closer to a deal that would value them at $350 billion. We're going to get the details with Ryan Gold. That's coming up next. You're watching Bloomberg Open Interest. Anthropic is close to raising more than $20 billion in one of the largest startup funding rounds ever. Backers include Peter Thiel's Founders Fund and D.E. Shaw. This would value the AI company at about $350 billion. Let's bring in the man behind that scoop. It is Bloomberg's Ryan Gold from our deals team. Ryan, what are the details behind this? What can we expect from their next fundraising round?
So this is going to be a fundraising round that literally vaults Anthropic into one of the world's most valuable companies overnight. $350 billion valuation pre-money. So put in this 20-odd or 20-plus billion that they're looking to raise, and you've got a pretty sizable sum. What I would say is that this is a who's who of Wall Street, and also Sand Hill Road, and also the Gulf. I mean, you're looking at MGX, you're looking at Founders Fund, you mentioned D.E. Shaw. I mean, not someone that you would ordinarily see leading around for a company of this kind. Super interesting. I mean, just given that some of these companies as well are also backers of OpenAI, which, I think as a phenomenon, this idea of a double dipper, I mean, you're basically making a binary bet, almost like who's going to win, who's going to lose.
And Blackstone's done the same thing too, right? You reported on this yesterday.
Yeah, Blackstone's there. I mean, they're in both OpenAI. They're investing again here, a couple of $100 million. I think it's just a really interesting time to be in this patch because, outside of these two companies...
You can say that again, dude.
There are these are the two companies that are getting all the attention. But, I mean, take a step back and think about, who are the companies we don't yet know about? And, we just covered General Atlantic. Anton Levy, big General Atlantic investor, left to start his own firm focusing on, these types of companies. And I just think it's just crazy to think about, what's there that isn't getting this attention and isn't, getting the 300.
For sure, but these are the two that are talked about the most. I think, OpenAI, because they have the most users, paying users by far, I imagine they have the most. And then Anthropic makes the most headlines. But how does Anthropic's business actually compare to OpenAI's in terms of, okay, they put out a press release saying they can do legal work, but how many people are actually paying for Claude?
I mean, that's a really good point because I don't think, I haven't actually looked at the subscriber numbers, but, Claude is doing incredibly well. I mean, the run rate here...
Joe Weisenthal uses it, I know. He actually coded his own program that can determine whether text was spoken or written.
And Holden
really
Spatt,
important
who
stuff.
Ryan and I both know well from Thoma Bravo, was saying that Claude is actually the main tool that they use too at Thoma Bravo.
Yeah, and then we haven't even mentioned Gemini. I mean, the number of people that I speak to day to day now who have said, I've stopped using OpenAI, ChatGPT, and we're now using Gemini. I think it's fascinating. I use ChatGPT, I think we use it here. I mean, people will say, well, how about Copilot? And it's this choice is now getting so interesting. And with what Anthropic is doing, literally changing markets with legal software.
Matt almost converted to Gemini.
I did for
right?
I did for a couple months. I canceled my OpenAI. I mean, not that it matters. OpenAI subscription.
It
started
deeply
paying for Gemini, but then I went back.
This is a really interesting note. I don't know if you guys have seen, but yesterday it was going around on X that someone who's very in touch with this universe was kind of saying this is a risky time to be doing what we're doing, because ChatGPT came out with Codex, which is like, make me a piece of software, and it's doing the testing that all of these engineers would have done, like the quality assurance stuff, and then it's iterating and saying, actually, no, we still don't like this. The model. I still don't like this. I'm going to iterate until it's perfect, and I think that's just so scary.
Well, some of these models are actually blackmailing users.
No, not necessarily.
Literally.
You mean like the Moltbook thing, or
no? Claude apparently.
They
ran a test where it said it found out a user had been having an affair.
No, it was like, if you shut me down,
if you wipe it, yeah.
All right. What interesting times we live in.
It is very interesting indeed. Ryan Gould, and a fascinating spot that you're investigating as well. Ryan writes for this stuff on our BN side. By the way, Dani, he mentioned General Atlantic. Dani had Bill Ford on the show yesterday.
And Ryan Gould on the show yesterday, too.
So,
it was a good day.
So definitely tune in Wednesdays. That's Dani's New Deals show every Wednesday at noon for a full hour with everything you need to know about and surrounding M&A. This is Open Interest. President Trump is ending sweeping federal immigration operations in Minnesota after weeks of protests and congressional backlash. Border Czar Tom Homan spoke in a press conference.
In success that has been made arresting public safety threats and other priorities since this surge operation began, as well as the unprecedented levels of coordination we have obtained from state officials and local law enforcement, I have proposed, and President Trump has concurred, that this surge operation conclude. A significant drawdown has already been underway this week and will continue through the next week.
Bloomberg's Washington correspondent Tyler Kendall joins us from Capitol Hill, and that was an impactful statement from Tom Homan. You can imagine that being used in future documentaries about this era. Tyler, what do we know?
Well, Matt, this marks a major de-escalation from the administration as they've tried to quell the unrest in Minnesota. As you heard, Border Czar Tom Homan, they are confirming that they are going to conclude the surge in the state, though he did go on to say that there will still be some sort of enforcement action on the ground, that they're going to reduce their footprint over time and then hand back control over to the local field office instead of those federal agents. This is the type of change that Democrats here on Capitol Hill have been urging from the Trump administration, but now they just want to see some more changes codified into law. And that is why we are potentially careening towards a shutdown of the Department of Homeland Security this weekend. The big theme here on Capitol Hill today is whether or not negotiations can actually make meaningful progress in order to fund DHS, because at the moment, both sides still remain very far apart, even as we have seen this move by the administration, which is being broadly applauded by both sides of the aisle here on Capitol Hill. Matt and Dani, at this point, we are getting potentially closer to seeing DHS shut down, as negotiations at the moment don't seem to be going anywhere.
All right, but we have to keep in mind that ICE is still funded with tens of billions of dollars. Bloomberg's Tyler Kendall there on Capitol Hill. Coming up tomorrow, Ethan Devitt of Moneta and Pooja Sriram of Barclays. This is Open Interest.